Foued says, if we want to avoid earnings season because of unsure market sentiment, do you have ETFs that you like to trade? Well, that's kind of a loaded question. Of course, Foued, what I mean by that is that if I'm trading, excuse me, folks, if I'm trading bull put credit spreads in current market, or if I'm concerned of the market turning from this current bullish run to move to bearish, as our last signal on the market sentiment tool was a bear signal, and we've seen some hesitation, but we're still kind of up where we were. Had this on a coaching session earlier this week. Let's just take a look. The last signals we had were around 615 for a bearish sell, and SPY was up at 44.25. It was building, 44.25, had the sell warnings, pulled back down into the low 4300s, 43.28, then moved right back up to where we were, but we stayed in the neutral zone, and now we're kind of right in this 4400 range. Okay, so we're kind of bouncing around. Had a little light day today. But in any case, if I'm opening bull put credits, bear call credits, by definition in my search, I'm using that feature to avoid earnings between now and expiration. Yes, uncertain earnings for big name stocks, Apple, things of that nature, could affect the entire market, could affect the entire tech market. Hey, I think Anet is a great trade. I think it's great for a bull put credit spread. I don't even think that's on the list right now. Okay, so I think MicroStrategy might be good for bull put. I know they had a big drop yesterday, but they seem to have recovered today as well. But I say, okay, I think MicroStrategy is a great position. Well, this is only 14 days out, but in that time period, if some of the other stocks in its sector industry had earnings and the earnings disappointed, that might pull down MicroStrategy, even though it's still a strong stock. The fear is that it's going to have the same effect. So that's something to concern about. But yes, I am trying to avoid earnings between now and expiration for those strategies. If I'm opening a new in-the-money covered call, just hoping to get a sign in the next week or 2 weeks, selling a cash-secured naked put that's out of the money, looking to generate 0.7, 0.8% for next week's series, or maybe 1 to 1.5% for 2 weeks out, I'm avoiding securities that have earnings between now and expiration. Always do that with iron condors as well. And that's a setting that you can do in any strategy under the fundamentals tab. Just check the box for earnings date, not between now and expiration. All right, that being said, what I just mentioned, we've seen in the past, right? QQQ has been affected, and the NASDAQ, QQQ has been affected during those big name reports of Tesla, Apple, things of that nature, if they disappointed in those rare instances, and they pulled down the market. Or there's a lot of tech in a 2-day period, and it could pull down QQQ or SPY, but it won't be pulled down as much. And we might see a strong tech stock, for example, fall 7, 8, or 9%. That might only bring NASDAQ or QQQ down 1 or 2%. So that's what Foued's kind of asking, a little bit of security on the position. Well, again, I mean, one thing we can always look at too is that if I want to trade stocks during earnings season, rather than just drift over to the ETFs, I could always do the married put strategy for earnings or things of that nature, knowing I can't lose more than 4 or 5% on the position, still have an unlimited upside, though I gave up some potential upside profit due to the cost of the put option in the married put structure. But the common ones you'd consider if you're concerned about earnings, and if you're concerned about an earnings season, you'd still be focusing on the main ones: SPY, QQQ, IWM, whatever strategy you wanted to trade. Now, that being said, I had a relatively fun discussion today. It didn't work out as well. It wasn't a discussion. It was for John. It was an email. And John asked, could I use the long straddle or long strangle screen for a way to evaluate potential pairs positions using options? Okay, now let me break. I know that's sort of a deviation from your question, Foued, but really, if you're just concerned about lower volatility ETFs to use as stocks are going through their earnings, it's going to be the big three. It's going to be SPY, QQQ, IWM, the Russell 2000 ETF. You probably don't want to mess around with the 2x or 3x ETFs because your concern is about volatility and sudden movements. And if QQQ drops 1.5–2% because of bad earnings on two tech stocks 2 days in a row, the TQQQ or the other 2 or 3 times ETFs are going to move more sharply, percentage-wise. So why take that extra risk if you're looking to avoid risk in the first place? Stay with the standards, stay with the big three. Now, where I'm going with this not confusing, but this sort of elaborate discussion, we're not even going that deep into it. Let me just add a long straddle that John sent to me today via email. Of course, we know long straddle positions where I'm going to buy a call, buy a put at relatively the same strike price with the same expiration on a security as I'm expecting a big swing one direction or the other. When would I be expecting that? Well, uncertain market conditions, uncertainty around interest rate hikes, earnings season. That's what we would be looking at in that case. Of course, if we're coming up to earnings on a stock, we're going to be paying a little bit more into a higher implied volatility, so we know the price is going to be higher for those options, but we're still expecting a swing one direction or the other. That's where the straddle play comes in. A pairs position, if those of you who aren't familiar, it's a standard idea of a stock position a double stock position where I might buy shares of an ETF such as QQQ or SPY, and at the same time, I'm going to buy shares of the inverse, or short, I should say. My apologies. I'm going to short shares of the inverse. So I'm expecting QQQ to go up. I'm going to buy shares of the positive, and I might short shares of the negative that's going to drop as QQQ moves up. A pairs trade to attempt to double dip. Now, a concept on that is that a pairs trade might work the same way. So, for example, if I'm bullish on, let's say I'm bearish on SPY right now because I saw the market sentiment, I'm concerned the next month or two might have a pullback, I might buy puts on SPY expecting it to go down. At the same time, I might buy calls on SH, the short S&P 500, because I'm expecting that to move up as this falls down. Well, naturally, the long straddle search would just show me a combination of SPY or SH or QQQ or the inverse of QQQ, for example. It wouldn't show me buying a call on one or put on the other. You can't combine them in the search that way. My answer to John was you could create your own list of regular and the inverse ETFs, or a 2x ETF and its inverse 2x ETF. Look for the straddles on both of those to see which one was the delta of 0.4 or 0.3 that you wanted to be out of the money with a strangle or at the money with a straddle. I know, a little confusing. Creating a stock list of those just to see, hey, I'm going to buy the put on SPY and the call on SH, or I'm going to buy the call on the bull 2x SPY and a put, strike that, reverse it. I'm going to buy the put on the 2x bull SPY and buy calls on the 2x bear SPYs for the next 30 to 40 days, expecting a slight correction before the market goes back to the bullish mode. That's not a recommendation or suggestion or outlook going forward. Okay, I know that was a little bit confusing and it's neither here nor there, but why I'm going through this little exercise is in 2022, and you can see some video discussions on this on the YouTube channel. I also believe in the, if I'm not mistaken, in sort of the option strategies discussion or options concepts here. What strategies you're trading in this market from 2022. That's when we were talking about the straddles or strangles 2 to 3 months out that I was using on SPY as the market was fluctuating up and down, and the market sentiment tool turned from bearish warnings and bearish sells to light buys and bullish buys. I was adjusting the strangle that was 2 to 3 months, 45 to 60 days, 45 to 75 days out of time, up and down, taking the profits off the one strangle position and moving into the next for another 75, 65 days out in time. And that was working out really well. But there was a lot of, I found some things that were fun, Foued. And so where I'm going with this is that you're concerned about earnings season and you want to have less volatility, so you're looking to trade ETFs. But I had some fun for 2 or 3 earnings cycles playing kind of a pairs trade in a sense, with just EMTY and XRT. What are these two ETFs? XRT is the SPDR, the S&P 500 retail ETF, following retail stores, things of that nature. And, when there was fears of how interest rates were going to impact, and interest rates and inflation, consumers needed to pay more on groceries. We're paying more on groceries. It was going to be harder for certain companies, Home Depot, Walmart, Target, Kohl's, things of that nature, to have discretionary spending. They weren't going to see the profits they were expected to see because money was being paid for higher gas prices, higher food prices. Discretionary spending wasn't there in the big box stores. So when I started to see some of the ETFs, some of the retail stocks first report, I think Kohl's was one of the first ones that reports. When I saw that they were negative, I started buying puts on XRT. So for the next week or two, my anticipation of those other retail stores were going to have relatively light or poor earnings due to inflation concerns and less walk-in prices, less discretionary spending. And then at the same time, never liked to bet against America, but I was buying calls when I started to see that on EMTY. EMTY is the empty decline of the retail store. So yeah, it's only $15, but I'd be buying puts on XRT and calls on EMTY. Then when I saw the first two retail stores the next quarter, the next two quarters start reporting really positive earnings, I would buy calls on XRT and buy puts on EMTY. Double dipping, taking a chance, only with a small portion of my portfolio, maybe 3 to 5%, because I could be wrong and they could both just stagnate and I could lose, buying calls and buying puts. You can stand lose 60, 70, 80% if you don't see the movement you want in a relatively near time period. And still, the IV is not that bad. Another advantage here is I didn't have to buy the calls or puts necessarily on XRT or EMTY. I could just buy 10 shares or 20 shares. Therefore, it doesn't have an expiration date, and I didn't have to pay into the higher volatility. But they weren't affected into the volatility range as much as a stock would be that came into earnings. Kohl's, Target, Walmart, things of that nature. So that's just an idea. That's a concept that you can kind of consider there, is double dipping, in a sense, around earnings, playing both ends. And Foued says, I'm liking lately ETFs like GDX, that's the gold, XLE is the energy, SPLG. If I want to implement married put with an ETF, is there any difference compared to a stock? Yes, there is. In a sense, there is absolutely, Foued. Let's talk about that briefly. Now that I've gone through my rough little discussion of playing around with a fake kind of pair strategy there, double dipping in retail, and there's other ones. Almost every ETF that exists now has an inverse, so you can play that around earnings too. If you start to see oil and gas having less than profitable earnings, you've got the OIH or the other oil ETF, and you've got an inverse for those too. So you can play bullish on the inverse and bearish on the regular if you want to. If you start seeing some of the oil and gas ones, the first two start having bad earnings.